Welcome back, Plutus people. Are you guys ready for the infinite money hack? Okay, fine. I'll admit that this is a clickbait title, but once you're over it and you look at the covered call strategy, it will blow your mind. It lets you keep your long-term stocks and still generate a healthy income. The first time I understood this strategy, it really blew my mind. And I was like, there must be a catch. So we'll talk about it today so that you can make money while keeping your stocks and long-term holdings in your possession. A covered call essentially means that you will deliver an underlying asset or stock that you own already at a predetermined strike price in a specific time period, but collecting a premium on that call that you sell instantaneously. So if that's gibberish to you, don't worry, we'll explain it with a practical example. But we are going over certain concepts that we have already covered on our channel. So please make sure you check out our video on call options, what an option is, and all the Greeks, especially delta, to understand this strategy effectively. Let's understand covered call with a practical example. I feel like that's the best way to understand a concept. So I'll use the example of a profitable trade I made, but I'm just substituting the numbers to very simple numbers so that we can understand these concepts easily. So let's say you own 100 shares of Tesla at 500 apiece. You have to own 100 shares because every option contract controls 100 underlying shares. So your initial investment is $50,000. You have bought 100 shares of Tesla. You sell an option contract with a strike price of 550 because you believe that Tesla will trade sideways. A covered call is always a mildly bullish or neutral strategy, which means that it will fluctuate between your price that you have paid and what your strike price is going to be. So I'm going to sell a covered call option at a strike price of 550, expiring in the next 30 days, collecting a premium instantly of $150. So the call option contract that you will sell will come up as strike 550 Tesla, expiring 30 days. They will have a timeline like June 24, 2021 with a premium of $1.50. But as you know, every option contract controls 100 shares. So it will be 1.50 multiplied by 100. So the premium is 150. So now the 150 is yours to do whatever you want with that premium. Typically what I do is I either keep it in my bank account or buy another stock that I'm interested in, that I'm bullish in, that I think would go up. So I put my capital to use, or you can generate that as income and collect that. So now you have sold this call option, a covered call. Cover meaning you have 100 Tesla shares just in case if you have to deliver them. And we'll talk more about what that means. So there's three scenarios that can happen right now. This covered call that you have sold will show up in your account as a minus 150 because you don't have this ended, it's 30 days out still. So first, to make it very simple, first scenario, Tesla in the next 30 days expires above 550. So Tesla in 30 days, let's say your expiry date was June 21st, 2021. On June 21st, 2021, end of trading day, Tesla is trading at $550. What would happen is that your call option contract that you have sold will be exercised. So you will make 50 times 100 because there's 100 shares. So you'll make $5,000 just from the sale of shares because you bought them at 500, but now they got sold at 550, but you will also make and keep the $150 premium that you sold your covered call for. So your net profit is $5,150 minus commission. But we'll make it simple. We'll do a follow-up video on pitfalls and things to consider when you do covered calls, but this is the ideal hunky-dory unicorn land scenario. So you have made $5,150. This is scenario one. Scenario two, your Tesla stock does not, it trades at $525, or let's say $549 at the end of trading day, June 21st, 2021. What would happen is that your call option that you have sold will expire worthless or out of the money. Now, this is the ideal case scenario if it ends at $549, because not only your 100 shares have appreciated to $549 from $500 that you bought them for at a theoretical unrealized profit of $4,900, but they also don't get called away because your option contract that you have sold has expired out of the money, and you also get to keep the premium of $150. you know what would happen now is, well, what I often do is that you will sell another call option 30 days later for another premium of maybe $120, $130, and you just keep going and keep accumulating money while keeping your underlying stock. Third scenario, which also happens in real life, because as we say in medicine, humans and real life does not read textbooks. So what would happen? The third scenario is that in the next couple of days, Tesla stock has dipped to 500, and so you have bought it at the strike price was 550, you bought them at 500, Tesla stock has gone down to 480. Now the same call contract is trading in the open market at a premium of 30 cents. You got a premium of 150 for selling it, but now it's at 30 cents, so $30. What I would do in that case is I would buy that contract back, close it, and roll it, selling another one. This is another concept that we need for future videos because there's other strategies, money-making strategies that we'll be talking about, so keep that in mind. So we roll it. But just to simplify it, those are the three scenarios that a covered call can end up in. So in order to summarize quickly, for practical reasons, what I do in terms of covered calls is I always buy stocks in increments of hundreds if I have the capital, and we will talk about, stay tuned, we'll talk about a poor man's covered call in our next video where you don't have the capital for 100 shares, but you can still use the strategy. Anyway, apart from that tangent, whenever I buy shares, what I do is I buy 100 of them in increments of 100. I always sell 30 to 60 days out in terms of the expiry date, strike price always above what I pay, and I always use a call option contract where the delta is 30%, 0.3. So there's only a 30% chance of your contract ending up in the money. So those are practical solutions for selling a covered call. Sell it 30 to 60 days out, because during that time the theta decay or the decay in the premium is the most. Sell it on a stock that has medium implied volatility, has a delta of 30% or less, and a strike price above what you have paid for those 100 shares. And there you have it, the infinite money hack. It's time for your favorite segment, Ticker of the Week. Staying true to the theme of covered calls, we'll be doing a unique Ticker of the Week this week. We'll be talking about ticker symbol ZWB. So that's the BMO Covered Call Canadian Banks ETF. Canadian banks are a stable investment, are solid investment, as you know, and we'll go into the reasons why that's the case. But let's talk about this ETF. So year-to-date return of 18 to 20% with a dividend of north of 5% and an expense ratio of 0.75%. You can't go wrong with it. On top of that, for Canadians, they can hold that in their TFSA as well as their RRSP without having to worry about selling covered call themselves. So if you learn from this video to sell your own covered calls, you can save on that expense ratio. But if you have no time and just want to harness the power of covered calls, you can have this ETF. And talking about the strength of Canadian banks, I do have a position in Canadian banks myself, but I don't have a position in ZWB, but it's the same thing essentially. But Canadian banks have been so solid as they are slightly more risk averse than our American counterparts. They have more reserves for bad loans or loans going south. They have also been prohibited or limited by the banking regulator to not increase dividends given the state of our economy. So all in all, there is a solid chance of a bullish pattern developing here, as well as a huge upside despite the banks trading at their 52-week highs. But we feel that there is, Plutus feels that there is still an increased chance of making some money. So keep an eye out on ZWB and tell us what you guys think.